When it comes to real estate and property, most of us have heard about emerging markets, yet there are a few that are aware of what is called frontier markets. Welcome to Stasia's Story, your source for learning more about Asia's future, as we highlight the rise of the largest continent on Earth. While some may use these interchangeably, they are in fact different. Every investor or property buyer knows the advice on buying low and selling high. One of the main judging factors when buying a home is the market quality. This is why it's important to know about emerging and frontier markets. Aggressive or risk-taking investors tend to invest in emerging and frontier markets as a way of getting larger capital gains in the long term. Let's take a look at some key differences between the two markets. When it comes to emerging markets, they offer adequate liquidity and stability and are good for long-term investors seeking a return on their capital. Emerging markets are also important because they play a part in the global economy. But it's important to keep in mind that different entities define an emerging or a developed market differently. This is evident from the fact that some emerging markets show clear signs of being a developed market, like Korea and China for example, yet continue to exist on the emerging market list. Frontier markets are less economically developed than emerging markets, but they cannot be included in low-economy countries. Overall, a frontier market is less established than an emerging market. They are considered the riskiest markets for investment, but they are still considered viable. Frontier markets are less accessible than emerging markets and oftentimes riskier. They offer less liquidity and don't have developed stock markets. Investors have to face lots of trouble while establishing an asset in a frontier country, including political instability and large currency fluctuations. The main benefit of frontier markets is that they can offer higher returns than emerging ones if things go well. Emerging markets can be defined as countries that aren't fully developed, but are instead continually developing. Some examples of emerging markets include Brazil, Malaysia, India, Indonesia, and many others. MSCI, an American finance company, emphasizes a few main points that define a market: economic development, size, liquidity requirements, market accessibility criteria. Every June, MSCI announces the results of its evaluation of the equity markets for countries worldwide. MSCI considers countries like Indonesia, India, Mexico, Peru, South Africa, China, Thailand, Taiwan, and many other countries as emerging markets. On the other hand, countries like Croatia, Estonia, Bangladesh, Vietnam, Zimbabwe, Jordan, Morocco, and many more exist in the category of frontier markets. This list, however, is constantly changing year by year. Russell Investments, an American investment firm, looks at two main criteria before analyzing a country's market status: GDP per capita and ease or safety of accessing the equity market. According to Russell, the biggest advantage of investing in a frontier market is that investors can find very inexpensive yet fast-growing companies with attractive valuations. Still, certain risks such as illiquidity, inefficiency, and volatility hamper the investment options. Most of the world's real estate trends center around the world's largest continent, Asia, with billions of dollars invested into Southeast Asia in the last several years. From the early 2000s, many frontier markets in Asia have gone on to become emerging ones, and some markets are even on the verge of becoming developed. But when judging any country's real estate investment trends, you should not make your decision by looking at the country's annual GDP. Instead, it would be best if you looked at the country's GDP per capita and other economic assets. For example, India's overall GDP is greater than Canada's, but the latter is considered a developed market while the former is considered an emerging market for investors. Some of the key differences between both markets can be seen as follows. The first difference is the sectors in the stock exchange. The stock exchange of frontier markets is mainly dominated by larger companies and is not as advanced as emerging markets. The stock exchange companies of frontier markets also share a large chunk of the market cap. Emerging markets are more broadly spread than frontier ones, and several industries like agriculture, manufacturing, services, transportation, IT, education, cultural prospects, and others contribute to the stock exchange. The second difference is liquidity. Frontier markets generally have many political, social, or even economic restrictions that don't allow many foreign investors to invest or buy property in those countries. Frontier markets also offer less liquidity than emerging markets. On the other hand, emerging markets give you easier access to investment. The third difference would be in investment products. While frontier markets are developing in terms of the variety in trading, the truth of the matter is, they still haven't been able to achieve the same level as emerging markets. Emerging markets and frontier markets are continuously changing and developing into better ones. They both have their own advantages and disadvantages, giving you completely different opportunities. Ultimately, it is your duty to analyze everything and determine the best type of market. If you like the video, feel free to read more on our official website, and if you haven't already, subscribe for more future updates and videos.